Okay, to kick things off, I really want you to consider this frankly staggering metric, a greater than 300% one-year total shareholder return. Now, in an industry that is notoriously plagued by cyclical volatility and just massive capital requirements, this quietly booming oilfield services company has managed to absolutely crush the broader market. The big question we need to answer is this: do they actually have a genuine economic moat, or is this just a temporary, fleeting surge driven by a shifting global energy landscape?
Welcome to This Explainer. Today, we're unpacking the incredible recent run-up of National Energy Services Reunited Corp, better known to most of us as NESR. I'm super excited to guide you through this one, acting as your resident investment analyst to break down their financial catalysts, operational milestones, and all those conflicting market signals that every serious value investor needs to be watching right now.
All right, here's our roadmap for today. We're going to break down that massive 300% surge, dissect the record Q1 earnings, explore this game-changing Aramco contract, weigh their new buybacks against some insider selling, and finally, we'll track exactly where the institutional smart money is moving.
Okay, let's jump right into Section 1, the 300% surge.
So, looking at the performance, NESR is up over 57% year-to-date alone, and it boasts this astronomical 300% return over the past 12 months. Now, you and I both know that truly extraordinary investment returns rarely come from just blindly following the herd. To figure out if this trajectory is actually sustainable, we really have to look past the hype and dig into the nuts and bolts of their fundamental operations over in the Middle East and North Africa, the MENA region, which is essentially their primary stomping ground.
Moving on to Section 2, the record Q1 earnings breakdown.
We're looking at a very stark year-over-year contrast here. Revenue jumped 33.5% to a record $404.6 million for the first quarter. But honestly, the real star metric for any fundamental investor is that middle figure right there. We're talking about a massive 129% surge in net income, hitting $23.8 million. This kind of explosive bottom-line growth, paired with a super solid $76.7 million in adjusted EBITDA, shows exceptional earnings power. It literally proves they're sustaining activity across their core markets despite all the regional geopolitical conflicts. I mean, this perfectly aligns with Warren Buffett's strict criteria for consistent, robust earnings.
And this is exactly where operational efficiency translates into that much-coveted economic moat. They're transforming roughly $404 million in top-line revenue into a very healthy $51.8 million gross profit. Keep in mind, the MENA region presents massive complexities, from tricky supply chain logistics to super localized operational demands. Yet, NESR has practically proven their operational agility, keeping their cost of sales manageable while scaling up incredibly efficiently.
All right, Section 3, the Aramco catalyst.
So, CEO Sharif Foda views the Jafurah unconventional field project as a true cornerstone achievement, directly anchoring NESR to Saudi Arabia's highly ambitious Vision 2030 energy plan. They actually initiated operations there back in 2019, and get this, their efficiency is now fully competitive with top-tier U.S. shale operations. This is all about deploying advanced, data-driven optimization in one of the absolute most critical energy basins in the world. It positions NESR exactly how Peter Lynch might describe a true industry stalwart or maybe even a fast grower.
Now this right here is the true engine behind all the optimism, a multi-billion-dollar 5-year contract with Saudi Aramco. Honestly, from a pure valuation perspective, this is a dream scenario. It provides multi-year earnings visibility extending all the way to 2030 and beyond. This massive long-term backlog acts as the ultimate catalyst. It significantly reduces volatility and gives analysts a highly predictable baseline to project future free cash flows, which is exactly what we need for solid intrinsic valuation and DCF modeling. Which brings us to Section 4, buybacks versus insider selling.
Okay, here's where the plot really thickens. On the bullish side of things, management just announced their very first capital return program, a $50 million share repurchase authorization, plus an anticipated 10-cent quarterly cash dividend. As Peter Lynch often pointed out, companies buy back their own shares when they genuinely believe the stock is undervalued. But, juxtaposed against this, a director-linked entity recently disclosed a Rule 144 share sale, which, if you're not familiar, is a regulation allowing insiders to sell restricted stock totaling about $146,000. Add to this the fact that Q1 free cash flow was actually negative $5.3 million, largely due to heavy capital expenditures on property and equipment.
So this introduces a really critical question of execution risk. Can management actually balance this massive regional expansion with their brand new shareholder payout promises? I mean, if tender timing shifts, or if collections from these national oil companies suddenly tighten up, those exact same cash flows have to somehow support both the heavy project investments and the newly authorized dividends. It is a very precarious tightrope walk of working capital that could totally threaten Benjamin Graham's all-important margin of safety if it isn't executed perfectly.
Let's move to Section 5, Institutional and Market Sentiment.
Big money is heavily divided right now, creating a massive tug-of-war. Millennium Management backed up the truck, increasing their position by an astronomical 1,482%, adding over 1.1 million shares. Dimensional Fund Advisors also doubled their stake. But at the exact same time, SCF Partners basically dumped over 6.4 million shares. That's an 81.2% reduction in their holdings. That is a massive exit. And you know, when whales make opposing waves this large, retail investors absolutely need to pay close attention to where the institutional ownership trends are heading.
Yet despite the mixed hedge fund activity and that bit of insider selling, the valuation models still continue to project a pretty steady upside. With the current trading price sitting around $26.50, the Wall Street median target expects a climb to $29.50. But more importantly, quantitative models assessing intrinsic value, very much like a Graham or DCF analysis, peg the stock's fair value significantly higher at nearly $32. This heavily suggests that despite the massive run-up we've seen, there's actually still a moderate margin of safety baked right into the current price.
So, considering the multi-billion-dollar backlog, the frankly record-breaking earnings, the divided institutional sentiment, and the complex geopolitical backdrop of the MENA region, we are left with one vital question. Is this incredible 300% surge already fully priced in, or is the Jafurah rally literally just getting started? Ultimately, it all comes down to their ability to execute and turn that massive backlog into genuine, tangible free cash flow. Thank you so much for joining me for this explainer, and definitely keep a very close watch on how these conflicting market signals play out over the coming quarters.